Hey, good afternoon, everyone. I really appreciate you giving me your time this afternoon. It's a Friday, and hopefully you'll find the information really profitable. Just a little bit, first, unfortunately, I have to start with a disclaimer that the information is for educational and demonstration purposes only. Wright Line doesn't take any responsibility for any profits or losses that may be incurred. We are not registered money managers. Please do your own diligence and consult a financial advisor prior to making any trading decisions. And with that said, just a little bit about Wright Line and a little bit, I think, about day trading in general. So what I'm going to show you in the next hour, and hopefully even less than an hour, because we have a lead going with Joe next, is really how to find low-risk, high-reward trading entries on the futures, forex, and stock markets. And I just want to talk real briefly about the problem with day trading and the problem with becoming a profitable day trader. What we do is we rely significantly on the information that's been handed down to us by previous traders who have all busted out of the market. I mean, the oscillators and trading methodologies that are currently being used are being used by the previous generation of day traders, 95% of which have all been unsuccessful. What we have to do as day traders, and I just want to say this further, that there's no other individual endeavor or individual field, that I'm going to call this of science, that would accept a failure rate of 95%. I mean, if you take architecture or medicine or any field of engineering, if 95% of all the buildings that were erected in the United States fell down or had major structural flaws, or 90% of the patients that were treated by doctors wound up getting sicker or dying, there would be major modifications made. What would happen is there would be very, very rigorous scientific studies performed to determine what was the problem, ferret out the failed techniques, whatever failed theories, and ultimately there would be an evolutionary process that goes on whereby buildings that were built stayed up and patients who were treated got better. In day trading, it just doesn't happen. 95% of day traders consistently bust out of the market, and I personally believe that 95% is low. I think it's closer to 97 or 98%. And one of the reasons is they simply take a priori as being true all of the trading methodologies that are handed to them by professed gurus, and the information that they use to trade is the same thing that's been provided to 100 generations of traders before them, all of which are no longer trading because they don't have any money. What we do here at Wright Line is we determine all the independent variables responsible for creating change in the price of an individual market, putting it in a multivariable equation and optimizing it. We can tell with a great amount of precision the direction of future price. Now, just a little bit about myself. I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I published close to 15 peer-reviewed articles in first-tier journals, and I've been involved in financial markets for over 20 years. And this software is the product of 10 years of analysis of price action, market structure, and indicator algorithms. And our software is based on mathematical modeling of closed systems using multivariable equations. Everything that we do is based on math. And we don't accept anything that anybody tells us as being true until we prove it. And most of the stuff that we've looked at, and I'm going to go over some of that with you, you're going to see just doesn't work. In fact, almost everything that we've been handed to just doesn't work. Now, this slide just goes on to make the same point that I was just making. That if you're utilizing the indicators and chart patterns that have been taught to all the prior generations of day traders, you're most likely encompassing at least a piece of a trading methodology that just does not work. And that is what leads to this high failure rate. In fact, if one indicator or one simple technique that you encompass in your trading methodology, if that doesn't work, it's really going to confound your trading entries, and it's got to be found, and it's got to be eliminated. Now, one of the most important things is trading with volume and using volume in a really, really powerful way to help you get great trading entries. And respecting volume profile generated areas of support and resistance is critical, and it's a fundamental component to successful day trading. You cannot trade without doing this. On any given trading chart, there are only 5 individual pieces of information that are provided to a trader. They are the high, the low, the open, and the close of a candle, and there's volume. Now, I see all the time there are these new gimmicky indicators that are going to tell you where the market's going to create a top 3 weeks from now, create a bottom 2 weeks from now. But they only have those 5 pieces of information to work with. And those are the 5 pieces of information that are put into all of the formulas that create indicator analysis. If you actually look at the formulas for an oscillator, or you look at the formulas for a MACD, or the formulas for any indicator, some of them use all 5. In fact, most of them use all 5. Some of them use a few lesser than 5. I didn't say that very well because it's Friday. The point being is there is nothing else to see on a chart. That's what's so critical about volume. And volume creates very clear-cut dynamic areas of support and resistance. And we're going to show you how to leverage them to help you increase the predictive value of your trading entries. Now, I call these core trading principles or secrets, but they're really not such a secret. If you could just hang on 1 second. I'm sorry. I'm getting an echo. I don't know how. But here's the first. Support and resistance based on volume zones are dynamic, and they undergo constant adjustment, and they're recalculating intra-candle. And the indicator or the system that is used to calculate support and resistance based on volume has to work intra-candle. If you're trading a 3-minute or a 5-minute or a 4-hour or a 1,000 tick, you cannot trade off the support and resistance zones based on volume that make that change or adjustment at the close of a candle. The other is that there's no formal zone of support or resistance. When resistance breaks, it becomes support. When support breaks, it becomes resistance. And you're going to see that a lot of these types of indicators create clear-cut areas of support or resistance, and that is simply incorrect. And based on all of this analysis, you're going to see how you can use volume to really get you into a trade that's really going to make really nice money. It will. I can show you where to pull the trigger and how to enter. I don't like the term start racking up profit. I like the term to pull the trigger to get into a very low risk, high reward trade. Now first, let's take a look at volume profile. This is simply an analysis of all the volume that crosses in a market in a fixed period of time on any financial instrument. And you can see that volume at price creates this kind of profile. Now, why does this profile actually have mathematical validity? Why is it so important? And what I want to do is show you why. And this is just another market profile. This is actually the volume profile. I haven't really gone into market profile yet, but we're going to do that in a second. Now here's our volume profile. You're going to see that it's been changed quite a bit, but it is simply a histogram analysis of the number of contracts, lots, or shares crossed at any given price on any financial instrument. Doesn't matter whether you're trading stocks, futures, or Forex. Now, in a perfect world, volume at price would be normally distributed. And this is where the mathematical validity comes into play. Volume at price is simply a series of randomly distributed data. And if this randomly distributed data in a perfect world would create a normalized curve, a bell-shaped curve, just like this. Now we're going to see that it's not quite like this, but this is the fundamental principle by which volume profile creates valid and important areas that must be respected when you trade. Now, by definition, the mean price or the average price when any set of data is normally distributed is right in the center of the curve. And this is simply the average price or the average value of this normally distributed data. Around that average price is a standard deviation's worth of data. Now, an additional piece of information is that when this information is normally distributed, the median, the mean, and the mode are all the same number. When it's skewed, the mean, the median, and the mode separate. And the basis of the skewing of those three values are some of the principles by which looking at volume profile and creating these areas of support and resistance are based on. And within that mean, median, mode, and that one standard deviation, there is a value area. In trading, we call it the fair value area. The point is that there's a tremendous desire for this data to stay within this area. The data wants to be distributed within one standard deviation of this mean, median value. And we'll show you how that works on the market. Now we're going to switch over to more market-oriented nomenclature. Here's the value area high, and here's the value area low. And this is simply that one standard deviation's worth of data that encircles the point of control, which in this normally distributed data is a value which is equal to the mean, the median, and the mode. Now, in real life, when we trade, Here is our market profile. And this is our 1.0 version. I'll show you the 2.0. And we made some really nice changes to make it more powerful. But the general principles, the bedrock principles, are still the same. Now, the black line is the point of control. And you can see that the values are no longer normally distributed. They're skewed. This is the mean, but the median and the mode are someplace else. But the core fundamental principle is that the value area high and the value area low encompass approximately 66 2/3% of all volume at price. The point of control is that individual price that is most commonly traded. It's got the biggest histogram value right here. And it's where traders have decided in this auction environment that they most commonly want to trade this financial instrument. Now, I have an 8 range of crude. This could be a 5 range E-mini. This could be a chart of Google or Netflix or Facebook. It does not make any difference. This is the volume distribution at price, or the VOP. This is the value area high and low, and this is the point of control. I simply put this blue line in to represent where the point of control would be if this data was normally distributed. Now, there's certain forces that come to bear. What I did here was I simply just tagged these important areas: point of control, VAH, and VAL. Now, what's really important, again, is that the VAH and VAL encompass 1 standard deviation's worth of volume. And remember, that is a key number in a normalized distributed set of data. This is not a normally distributed set of data. So one of the things that we did was to see if there was a better number than 66 2/3%. What creates the best VAH, VAL, and POC to create areas of support and resistance that are tougher to break. And what we found that this number can be optimized. And that's really the key goal that we have in trading, is to optimize the parameters of every single thing we trade, and we came up with a better volume number. Now, it's between 66 2/3% and 70%. I can't tell you exactly what it is because it took us a lot of time to find out. But our VAH and VAL do not encompass exactly 66 2/3% of volume. Now, here's the force that comes to bear on price. And if you don't respect it, you're going to really have trouble trading. Remember that between the VAH and VAL, traders have decided this is the fair market value for whatever you're trading. It doesn't matter if it's a stock, a future, or a Forex market. This is not a fair market value that's been determined by an indicator. It's a fair market value that the indicator has elucidated for you because it encompasses a standard deviation's worth of volume. This is where traders want the price of this financial instrument to be. So what happens when price approaches the VAH? It gets repelled and pushed down. What happens when price approaches the VAL, or the value area low? It gets repelled and it gets pushed up because there's a tremendous force that's operational in the market to keep price within this fair value area. Now, the point of control is that price that's most commonly traded. And there's a tremendous attraction of the point of control to price. So price is being pushed up by the value area low, pushed down by the value area high, and is being attracted to the point of control. And if you can't see that on your trading chart, then you're trading at a tremendous disadvantage. because the VAH, when price is below it, is acting as a tremendous area of resistance. The value area low, when price is above it, is acting as a tremendous area of support. And the point of control wants price to come up to it and stick. So again, it is also a strong area of support and resistance. When you trade with volume, though, there are different forces creating support and resistance. And I'm going to show you even more about how we create areas that are even stronger areas of support and resistance to try to get you a trading opportunity that's optimal. Now, again, I can't emphasize enough how important it is to make sure that market profile is dynamic, because the volume profile, or this histogram, which determines it, is constantly changing. Every time a share is exchanged, or a contract, or a lot, in some imperceptible way, this histogram is changed. And so all of these values have to be modified intra-candle. You have to see where they are at the time you take the price, at the time you take the trade, and they must be recontouring in a dynamic way. Or if you wait for that 3-minute bar to close and decide you're going to take a trade at the close of the candle, and you're in the trade one tick above the close, you could wind up trading right into support or resistance. That's what you need to avoid. That's why you need that dynamic calculation. Now, in addition to the VAH, VAL, and POC, there are two other critical areas that almost no other volume profile or market profile elucidates. There are lots of low volume nodes present on this histogram, and a low volume node has to be given certain parameters, because there are lots of prices here that traders just simply are rejecting. But what are the critical areas that traders are rejecting? So what we did was we defined a critical low volume node that is close to the value area high, and a critical low volume node that is close to the value area low. And although these histogram bars in our market profile 1.0 are small, you can see how tiny that histogram bar is and how tiny this histogram bar is. Very little volume at price is crossing at these low volume nodes. So now, let me see if I have it here. Okay, now what you have when price approaches the low volume node, it's going to be rejected for two independent reasons. The value area high is rejecting price simply because of the desire for price to remain within that fair market value zone. The volume of the value area high is irrelevant. It's based on that 66 2/3% or so. I mean, we've modified that number a bit to make it better, but that's the mathematical parameter that's pushing price down. The price that's pushing price down off of a low volume node is simply is that it's a price that's been rejected by traders. Traders don't want to trade this price. It's exactly the opposite of the point of control. Traders love to trade price at the point of control and hate to trade the financial instrument at a low volume node. So what it does is it creates zones of rejection. And these zones are extremely powerful. I do not trade into these. Now remember, the distance from the low volume node to the VAH can vary. We give it some leeway and it can separate a certain degree. When it separates a large degree, there is no relevant low volume node. The same thing with the value area low. But the more confluent these two lines, the more difficult it is for price to move through it. So a confluent low volume node sitting close to the VAH and a confluent low volume node sitting close to the value area low are going to create these zones of rejection that are really going to be very difficult to penetrate. You are not going to want to take a trade into one of these. Now, if the zone is very, very wide, then you could potentially trade. But what you get to do is make an objective assessment of how difficult the zone is going to be to penetrate. And with a little bit of chart time, you're going to get a great feel for whether you have a chance to make it through. In general, it's a very difficult zone to penetrate, and you can see exactly why. You know, it's not some black box system, you know, based on smoke and mirrors. This area is a price no traders like, and this is the price that bounds, that circumscribes fair market value. It's just that simple. Now, here's the mistake I see all the time, is that indicators that are created by other software vendors create fixed areas of resistance here, and they will color them red, and support here, and they will color them blue, and they're fixed. And this is totally inaccurate, and this is why so many day traders fail. These areas, first of all, are only operative on the right edge, because the right edge is the only place that's making an accurate, that is taking the data from volume profile where the market's live. So you can't draw these across the chart. Doesn't work. In addition, this isn't a support zone. It's a rejection zone. Price will eventually break it, and when it does, it turns support to resistance. And when this breaks it to the upside, it's going to turn resistance into support. So it's never correct to label these support or resistance at all. It's all dependent upon where the price is. Now, there's more information that you can use to leverage volume, and this is a really important additional component, and it's called the market delta. And we leverage the market delta in a very, very, very powerful way. Unfortunately, on this slide, all of these are zeros, because the market delta information on NinjaTrader is not saved. So when you open it up in the morning, I open my NinjaTrader up at midnight so we can accumulate this data for the trading morning. And I don't open it up 5 minutes before I'm going to trade. So it's got a nice set of data. Now, we store some volume data, but for every time that we seek to store data, the indicator uses more system resources. So this is information we don't choose to accumulate and store in the indicator. And it is the buy-sell imbalance inherent in the sum total of all the ticks of the candle. So in each tick, when they're added up, if there were more traders on the buy side than there were on the sell side of the dome, this is going to be a positive number. If there were more on the sell side, this is going to be a negative number. Now, there's also a volume ladder, which we also leverage, which tells you the buy-sell imbalance within each individual tick, or cent if you're trading stocks, or pip value if you're trading the forex markets. And I'll show you exactly how we use it. What we've done, I'll give you a little heads up, is we've eliminated these individual numbers because they're very hard to interpret, and what you want to do is look at something that has future predictive value. We don't care what the number is in the past. We only care about what it tells us about the future movement of price. So what we do, and I wish I would have accumulated more delta, is what we do is we take these numbers off the top of the candle and we create a delta moving average. And unfortunately, this is all the data I was able to accumulate in the slide, which is really not so good. This should come all the way across. But when you see it's green, you know that there's an abundance of buyers sitting on the buy side as opposed to a number of the sellers. And when it goes red, you have an abundance of sellers sitting on the dome as opposed to the number of buyers. So it gives you an idea of buy-sell pressure at any given moment on the market. And the important thing is, where is it on the right edge? And you can see right here, you see this opaque area here? That's our resistance zone. Here's our value area high. Here's our point of control. I'm sorry, here's our low volume node. Here's our low volume node, and here's our value area low. We only create this zone on the right edge because if you move back across the slide, you're going to see that the value area low and low volume node move around. So this is the only place we make it relevant, and that's why we color this opaquely like that, to tell you that, listen, look, you're trading the right edge. This is what's important. And you can see price came up to this zone and was rejected by the zone. It happens all the time. So if you traded into this zone, you would have gotten a loser. Now here's what we do that really gives this a real punch. And in addition to that, this is the moving average of the delta of your trading chart. But what we wanted to do was to take the moving average of the delta of the two higher time frames and create an order flow direction. We could have called it the delta moving average direction or the order flow direction. It's the same derivation. And what we've done is we've looked at the moving average of the delta, which is these numbers, of your two higher time frames. On the E-mini, on a 5 range, it's the higher fibs. It's the 8 range and the 13 range. If you're trading a 3-minute, it's a 9-minute and a 27-minute. If you're trading a 377 tick, it's going to be your 610 tick, and it's the two higher fibs, 377, 610, 987. And we're only looking at the delta moving average from the higher time frames and ignoring the delta moving average from our trading chart, which is here. We can see what it's doing on our chart. What really gives the market predictive value out into the future is what's the direction of our two higher time frames. Now you can see when the moving average of the delta or order flow is moving to the downside, you are only going to trade in the direction of this line. Now when this is red, the delta moving average of the two both higher time frames is down. Overabundance of sellers. When it's orange, there's only an overabundance of sellers on the highest time frame. But the highest time frame rules, and that's the direction you're always going to trade in. When this is red and orange. When this is green and blue, there's an overabundance of buyers on either both higher time frames, or when it's blue, just the longest term time frame. And if you try to counter trade against the direction of order flow, the likelihood that you're going to run into a loser is extremely high. If you trade in the direction of order flow, the likelihood of taking a loser is significantly lower. And this is what we're looking for. We're looking to leverage these independent variables. Order flow is an independent variable, and trade in the appropriate direction to increase the predictive value of an entry and getting us to at least the first target and making money for us. Now, intra-candle, we have what's called a volume ladder. It tells us about buy-sell imbalances inside the candle. And this is very oftentimes interpreted incorrectly. This is not going to tell you if the candle is going to continue to the upside. And traders who leverage this volume ladder, thinking that if there's this great buy disparity in the top tick or the top cent or the top pip, of their trading chart, no matter what you're trading, whether it's time, tick, range, Renko, no matter what market you're trading, is absolutely incorrect. What it does is it tells you what's going to happen when price rotates back around and is going to hit this area. Now, everybody talks about hidden buyers and hidden sellers. There's no such thing as an area where there are hidden buyers and hidden sellers. If you have the right indicator, it's going to tell you where they are. And right here at this tick, there's a large confluent number of buyers. So when this comes back down, this may act as a weak area of support. And this may act as a weak area of support. Now, in our 2.0 version, this is all present. I'm going to show that to you. Because our 2.0 version is operational. In our 3.0 version, what we're doing is we're working on contouring volume profile to give us predictive value about a trade continuation, but more importantly, to give us some predictive information about whether this candle is going to break a pivot or a moving average. So if we're not in a trade, we can take it, or if we're in a trade, we're not going to exit the trade as it moves up to resistance. Normally, you would not anticipate break, and you would close the trade conservatively, anticipating a bounce off resistance. We're going to try to give this predictive value as we move up into resistance or down into support. That's our 3.0 version, but it's not out yet, but we are working on it. So let's take a look at some live trades. Now, remember, we're taking them off the right edge where this area is operational and active. And you can see the trade came up, came back to support. We've got these two lines. The bottom line is order flow and up for 17 ticks on crude. Now, I'm going to tell you, that I don't even have this on the slide, but these two lines represent two different parameters. The bottom line is order flow on a multi-time frame basis, which is simply the moving average of the delta. The upper line is momentum on the two higher moving averages. And for the first 5 purchasers, we're going to give you both these lines. So you're going to get a more powerful indicator in addition to a bunch of other stuff. I didn't open this to give the delta moving average time enough to accumulate a direction. You can see it's just flat. I'm sorry about that. You're going to see slides where it's not. Here's another trade taken off support. The bottom line is the order flow line. And we're always trading in a direction of order flow. And you can see we broke, came back to support of this rejection zone, and we went up for 9 ticks. Now, these are real trades I took. These are not hypothetical trades. Now, I just wanted to represent to you, these are not real trades, but I want to give you an idea of how important it is to respect these areas and to respect order flow at the same time. And these are all hypotheticals. But these are real. In other words, I didn't take these trades. When price comes up to resistance, you can't take a short here because order flow is in the wrong direction. When price comes up to resistance here, you can't take a short because order flow is blue. You can't take a trade against the direction of order flow. And we'll take a look at these setups. When price comes back to support, you can go long because you've got order flow in your direction. Price comes back to this zone of rejection, you can go long because you have order flow in your direction. Back to support, you have order flow in your direction. Up here, you can't take account of trend trade-off resistance. Order flow is not in your direction. You have to wait for order flow to turn, and there's your short trade for 33 ticks down to support. Then when you break support, you wait for a pullback to resistance and a continuation short as long as multi-time frame order flow is in your direction. Here's the same thing here. Now you come down to support, but order flow is not with you. Now this is what's called trading with specificity. If you want to get into every winning trade, you're going to be sucked into lots of losers. This was a winning trade based on your trading rules that you just couldn't take. And you're not going to get every winner. What you're going to try to do is filter out almost every loser. And that's what day trading for profit is all about. It's not getting into every winning trade, but having the specificity to sidestep every losing trade. This week, I only had 2 losing trades the entire week, and we made really good money. And it was my ability to avoid the losers that created all the wealth, not so much my ability to take the winners. The winners come. It's avoiding the losers. Now, you can't take the trade short here because order flow is telling you to only go long. You can't take it short here, even though it's a winner. But here, off the point of control, acting as resistance, you can get a 61-tick trade in the direction of order flow. So don't take these high-risk turns. Don't take this bounce off support. If order flow doesn't support the trade, stand aside, and even if it's a winner, don't worry about it. Your big trade will come when all your rules align. And here's another trade. And I wanted to show this simply because a technical break of support or resistance based on Japanese candlestick dogma is a 2/3 candle close above or below an area of support or resistance. Now you can shave that a little bit and take this retracement candle and this continuation long, knowing that you still haven't technically broken this zone of resistance. If you wait for the next candle, you're in a safer trade, but you've given up a few ticks. And it all depends on your risk tolerance. What's important, though, is you're trading in the direction of order flow. You're letting it come up, retrace. This is not really retesting resistance. It's really hasn't broken it, but this candle has, and that's your low-risk entry. And these are trades. These are live trades again in the direction of order flow. 24 ticks in the direction of order flow, away from zones of support or rejection, sitting right on the support zone. I had to put this support zone in because this slide is not on the right edge. This is not a fudge. This is really where support was when I took the trade. And you can see inside these candles, you can see the volume ladder, telling you whether there's an overabundance of buyers or sellers at any given tick level. Now here, it's where you're just simply going to stand down. Sometimes these zones become so now this upper zone is fairly weak because it's not confluent. The value area low, value area high, and this low volume node have separated. This is a more confluent zone, so this is a tougher zone. But the point here is that when price is bracketed by support and resistance, I don't care what order flow says. You have to break resistance to the upside or support to the downside to trade. When you see this occur, you just take your hand off the mouse and you wait. You wait for a break of support and a retest and a move to the downside with order flow, or you wait for resistance to be broken to the upside and a retest and a move up in the direction of order flow. If you do that, the predictive value of your trades is going to skyrocket. Here's another trade in the direction of order flow. The very confluent zone here was broken. And then we came back to resistance and traded down in the direction of order flow for 18 ticks. That's a real trade. Here's a real trade. There's order flow. There's the zone. This is where it was on the right edge. Comes back to support and goes up for 2.5 points. And this is just a very recent trade. This was on 5/19 on the E-mini. 7.5 points and 2.5 points. And here is the delta. I finally got a slide where we've got the full delta, and you can see that there's clear-cut buying pressure or overabundance of buyers throughout this whole period of time. And in addition, order flow, the lower line, which is the moving average of the delta, is green on every entry I took. This went for 7.75 points before a reversal candle, and this went for 2.5 points before a reversal. I took both of these entries, always trading in the direction of order flow. And now that we had a live market delta, enough information, you can see how important the delta is as well, telling you that there's an overabundance of buyers sitting on the dome trying to push this price higher. And you can see all the intra-candle buy-sell imbalances. Here's another trade with market delta. The move up, break back to support, up for 20 ticks on crude. Trading with a two higher time frame delta moving averages and the delta on our trading chart. When you leverage volume like this, the predictive value of your trading entries is going to be remarkably higher. Now look at these traders in these orange candles. They're trading against multi-time frame order flow. Now, I don't know what they're thinking, and I know you don't know what they're thinking, but they're thinking something. Maybe they're trading oscillator divergence. Maybe they're trading MACD divergence. Maybe they're trading off of Fibonacci resistance, which Fibonacci is a hoax. I don't have the time to show you why, but it is. They're trading off of something that's telling them that this is a top. And they're counter trend trading the direction of order flow, and they are definitely destined to lose. Almost always. You're not going to do that. So to recap, here's the keys. Volume profile creates market profile. It must contour continually every time a contract or a lot or a share crosses. That volume profile has to be dynamic. It creates a VAH, a VAL, and a point of control. The low volume nodes create those zones of rejection. The delta moving averages are key. The one on your trading chart and your two higher time frames create order flow. The only thing that I left off of this is the intra-candle buy-sell imbalance, which is the volume ladder. Now, here is our special offer. Now, for the first, I left off one of them. For the first 5 orders only, you're going to get 3 months in my trading room for nothing. And I'm telling you, in the live trading, we make money almost every day. We made money every trading day this week. Today, we made $35. I'm not going to kid you. I'm not going to tell you we make $10,000 a day. And if you want to go into someone's trading room that tells you they make $2,000 a day, be my guest, because it's just not going to happen in real time. I trade on the right edge. I trade with Chart Trader up. I trade with my dome present. I trade live in real time, and if I make money, so does everyone in the room. But we made over $300 a couple of trading days. We only trade 2 contracts, a very small number. We had a great week, and we didn't have one negative equity day. And avoiding a drawdown day is key. You get 3 months in the room. Then you're gonna get my 10 module week educational training session. Now we're on module 4. There's supposed to be an hour. Last Wednesday, I went from 1 o'clock in the afternoon until 3:30, 2.5 hours of live training. And what we do is first we start with reading price action. And when you become a terrific price action trader, what we're doing now is doing price action and market structure. And that's very difficult to do. It was our first price action market structure module, and it took me 2.5 hours to finish all the material. After the question and answers, it was a 3-hour session. Now they're all recorded, and they're on a link. And because you would be coming in on module 4, you would get the first 3 modules on a link. But you'd have 4 through 10 live. We're giving you that for free. And I'm giving you this. I didn't even put it in here, but I'm going to show you it right here. Let me just give you a good example. I forgot to type it in. Here, the lower line is order flow determined on a multi-time frame basis. The higher line is momentum determined on a multi-time frame basis. Your highest probability trades are the predictive value of your entry is going to be highest when multi-time frame momentum and multi-time frame order flow are in the same direction. Now in this trade, I let momentum go. They're independent variables. And if you don't have them both in your direction, you're increasing the risk of the trade. And I understood that this continuation long was riskier. And it actually came back 6 ticks on me before it went up and gave me a winner. And my stop is 7. So let me tell you, I had a lot of sweat on this trade. And the reason I sweated it out was because I didn't trade with momentum. But when both these lines are red or both these lines are green, you've got a great predictive, you have great predictive power. And there's not much to talk about on momentum. I didn't want to do it because it's not a volume metric. But what it does is it simply uses the MACD momentum on your 2 higher time frames. If you try to use a MACD on your trading chart, it's useless. Well, if you look at momentum on your 2 higher time frames, it has awesome predictive power. You get that too. So those bottom, you're going to have 2 confluent lines down there. And so normally the 2.0 version, and soon we're going to have a 3.0. It's not out yet, and that's going to give us our volume ladder with predictive power, whether we're going to break or not break an area of support or resistance. But what we have now is a terrific tool that I can't trade without. It's normally $15.98 with the add-on bonuses, and the add-on bonuses really are excellent. And we're going to give you all of that for $7.99. Now the offer expires on June 5th, but you're not going to get the add-ons, which are the 3 months in the room, the 10-module weekly educational series, the add-on indicator, which is the multi-time frame assessment of momentum, unless you're one of the first 5. So let me see if there are any questions, because I really want to turn it over to Lee in 6 minutes. Okay, hang on really quickly. You know what? You can use the VWAP, but what I found is that they don't increase the predictive power of your entry, Romaguru. We've added it. And the thing is, if it doesn't increase the precision of the trade, then there's no reason to leverage it. And what we've done as the system has evolved is we've thrown out a lot of stuff, because what we do is we run 2 years of market replay data and look at our equity curve after those 2 years of transpire. We run it at 500 speed, and we add or subtract certain independent variables like the VWAP and other data to see if they make our entries better. It just doesn't make them better, so it's not a variable that we use in the trading. Dark pools, I don't know much about. I don't want to give you an answer if I'm not familiar with it and I don't understand that. So I don't want to. Roma Guru, if you trade with 100 contracts and you're asking if you could trade 100 contracts without sweating, you can never trade 100 contracts without sweating. I would need to be on 35 Valium if I trade 100 contracts. And here's why. If you trade with a positive predictive value of 80% or greater, and every trade you take is perfect, 20% of your trades will still fail. Now, if you stay with the predictive value of 80%, you can trade 100 contracts because you know if 8 out of 10 of your trades are successful, you're going to make amazing money. But on any individual trade, I would still be nervous with that, leveraging that kind of money. But that's just me. I'm nervous when I trade 2 contracts because I don't like to take a loser. But that's just my personality. And we've had people call the office and tell me I make them nervous when I trade. And we've had other people call and say they like my enthusiasm and my screaming when we get a full winner, like when we make $400 on one trade on 2 contracts. So that's just my personality. The key is if you're certain that you can trade with a predictive value of 80%, you can trade 500 contracts. The amount of money you can make is solely dependent upon the number of contracts you want to trade and the number of contracts you want to risk. Eric, the performance this week, we made about $650, but we only had 3 trading days. Remember that Monday was a holiday, and on Wednesday, I was sick. It's really rare that I get sick, but I was sick, and I could not trade. So we did that on 3 trading days. And in those 3 trading days, I had 9 winners and 2 losers. And that was our equity. So that was tremendously good equity and a predictive power, a positive predictive value of under 80%. One more winner would have got me 80%. That's what we did. That's what we did this week. Everybody in the room made money. So I just want you to know, I'm never going to give you I made $8,000 because I'm just going to only trade with 2 contracts. Hey, the institutions have the money, man. Institutions, I used to follow the tape. They'll bang through 900, 1,000, 1,400, 1,500 contracts. They'll trade thousands of shares of stock, and they won't even blink. But remember, if they take a loser, they don't even care. But they rarely do because they control price. Fitzroy, let me see. Do you have more regard for the longer? Well, I think that's a really good question. And you know what? Here's the thing, Fitzroy. Fitzroy's asking about trading the point of control and whether I'm looking for a long above the POC and a short below the POC. We don't know based on these charts where the higher term time frames are. Remember, we're a multi-time frame system. And let's say our 2 higher time frames are both pointing up. I'm looking for a long trade and a break of the value area high. Let's say our 2 higher time frames are trading short. I'm looking for a break of the value area low and a short trade. I'll take a break of the point of control. And this is reflected right here in this data. This is assessing data from the 2 higher time frames. This is setting my direction. So if the point of control, and let me see, we have it here. See, if my point of control is here, I'm going to look for a long trade above the point of control and above the value area high because I've got order flow long. And on this trade, here, I'm looking for a trade right through the point of control, long, because I've got order flow on the 2 higher and momentum, which we're going to give you in the first 5 packages. I'm looking to trade in the direction of the higher term time frames. The background bias, which is another indicator that's not included, assesses the trend of the higher term time frames. This is the momentum of the higher term time frames, and this is order flow of the higher term time frames. And the delta, which I have here, is the delta of our trading chart. We use almost nothing that takes data from our trading chart, but the delta of the trading chart is important. We want all of those parameters to align to give us the highest possibility of getting a trade that wins. Okay, the volume on the left side of the chart, that's a really good question. What we do is, it all depends on the volume of your trading chart, Michael. It's going to accumulate if this doesn't accumulate data and store data, when you open your chart in the morning, this volume profile is going to be based on a real scarce amount of volume. What we want to do is we store, I can't tell you the exact number of days because it's very difficult to determine how much to store. If you store too much data, then the volume from the trading day doesn't move the value area high, low, and POC they don't make them nimble enough to catch really nice volume moves. If you store too little data, they get pushed around by every stiff breeze that comes along. So we store a proprietary number of look-back days. I can tell you it's more than 2 days and less than 4. I'll give you an idea. And that's what creates the fact that this is the only indicator we have that uses some system resources, because we store this volume data. So when you open it up in the morning, this volume profile still has nice predictive power in creating the market profile. That's a really great question, by the way, Michael. I trade options, and we have an options alert newsletter, and we have 40 closed positions in 2017. We have 28 winners, and we have 12 losers. I think that's a stellar options performance when most options traders and most options portfolios give you 7 losers and 3 winners out of every 10 trades. Right now, we are sitting in a lot of winners. I mean, I have a spread on Amazon. I mean, I don't want to go through them all. I have a spread on Apple. I just closed out a spread on Google. We made $10 a spread. I just opened up a spread on Visa. I opened up a spread a while ago on I have it in front of me, but we do, and I trade, you get all my option signals off of our software, and they are very good. We do, Eric. All you got to do is mail it to us, and just either fax us or just give us the number. That's all. The bank and the number, and we take it, and we'll set you right up immediately. We don't even wait for it. I mean, we've never had anybody give us a problem with that. Aaron, the colors, and remember, these are the only colors that are relevant. I have to show you. All right, let me show you what's relevant. These 2 lines down here are extremely important. The first 5 get both. The top one is the multi-time frame assessment of momentum, and they're assessing momentum on the 2 higher time frames. The bottom is the multi-time frame assessment of order flow on the 2 higher time frames. The indicator algorithm sets the higher time frames based on your trading chart. If you trade a 3-minute, it's going to use an algorithm based on a 9-minute and a 27-minute. If you trade a 5-8 range, it's going to go to the 2 higher fibs, 13 range, and 21 range. If you trade a tick, it's going to default to the nearest fib number and then give you the 2 higher fib numbers. So if you trade a 377, the highest time frame is 610, and the next one after that is 967 or 77, something right around there. So it's assessing the 2 higher time frames, the direction of the delta moving average, and this is direction of momentum based on our own proprietary MACD system. And these are very important to give you a trading direction. When they're both green or blue. Now, when they're green, both higher time frames are long. When they're blue, only the longest term time frame is long. But remember, the longest term time frame always rules. So blue or green gives you the long prediction. When they're red, both longer time frames are down. When they're orange, only the highest term time frame is down. But you can see, here's the key that I really, and everyone stayed for this, I really appreciate it. Here is the key. And the key is this. When you look at some indicators, and the indicators that are moved by price on your trading chart, when price on the trading chart falls, the indicator falls. When price on your trading chart goes up, the indicator goes up. So it looks great. These lines ignore price on your trading chart. They're looking at price on your higher time frames. So the reason they have predictive value, and the reason you can see they work, is when both these lines are red, price is falling because they're red. The falling price doesn't turn them red. So it's giving you a clear-cut direction. If you try to trade in the opposite direction, you're looking at trouble. And what you want to do is take a low-risk entry. They're not going to give you every entry, but they're going to set a direction for you that if you trade in that direction, the possibility of getting a winner is extraordinarily high. Now, I only have one chart, unfortunately, and I'm really sorry about that, where I have the delta from your trading. That's right here. This green line is assessing the buy-sell power on your chart. And when you have this with you, on this entry, multi-time frame order flow and momentum long. My delta, long, green. On this continuation, look down here, blue, green, blue, green. My delta on my trading chart, green, up we go. That's the power it has when you trade in this direction. Stops, DQ, all depend upon the size and time frame of your chart. And whatever you want to trade, we have, and I don't want to, I don't want to run over. I'm only going to go 2 more minutes, and I apologize. Creating an automated trade management strategy that's optimized is based on the average true range of your instrument. We do it mathematically. It's a very, very complex parameter to determine. People always say, if I risk $1, I want to make 3, but you know what? You can't always do that. You can only take from the market what the market will give you. If you create a if you trade a very high volatile instrument, you need to set a bigger stop, and you can set higher targets. And that's all done mathematically. You tell us what you want to trade, and we'll tell you the stop and targets based on math, not based upon what you want or I want, but what the market's going to give you. So listen, the longer term time, the shorter term time frame is always going to move in the direction of the 2 longers. I mean, it's almost always that way. They're setting the direction. And I'll just say this really quickly. When you have a multi-time frame, the market inherently wants to move and chop. That's based, I know it's weird, but it's based on the law of thermodynamics. Every closed system wants to move to a period of maximal randomness. How do you get 3 time frames to align? Only when institutional money is brought to bear. When your 2 higher time frames are up, say on this, your 21 range, when your 13 range is going up, and your 5 range is heading up, that's because institutional money is pushing this market up. In the absence of big money, all of these time frames are going to move in different directions. You're going to get no background color. Momentum is going to be all different colors. Order flow is going to be all different colors. That's when you stand aside and you don't trade. It does. It does. I can't reset that, John. You want to see more than 2? I can't reset the amount of volume that's stored here in this volume profile. That's part of the intrinsic code of the indicator. I can't do that. I don't day trade options, Romaguru. I swing trade them. It runs on NinjaTrader. It'll soon be available on Sierra. About 5 days. You're very, very close. Derek, everything is going to be... I do both, Derek. If the option is extreme, if the option spread costs me a lot, I'll take a credit spread. If it's cheap, I'll do a debit spread. That's how you determine whether it's a debit or credit spread. The symmetry of the trade is identical. Your targets are identical, but if you're going to get a lot of money for the spread, take the money and take the credit. If it's a cheap spread, pay it. No, they're both equal, Aaron. You want them both in your direction. Right now, only on Ninja. Only on Ninja. But it's going to be on Sierra soon. So listen, everyone, let me turn this over to Lee. I hope you'll come aboard. This is a really great system. Let me give you our phone number right here. I'm sorry. Hold on. And let me get this to Lee. And I apologize to him for running overtime. Lee has a great system. Lee is a terrifically honest, diligent, great trader. It's just a different system than we trade. He trades the news. And I don't know what happened. Hold on 1 second. I'm sorry. And really the reason I can proffer him so strongly is simply because of the fact that he really, he's just so transparent. You just don't find people like that in this business. Oh, hang on 1 second. Whoever's texting me can please stop. I'm just trying to get these slides aren't moving. I'm sorry. Hang on 1 second here. And then I'm going to turn it over to Lee. I don't know why they're not going down. Rory, just can you put that in there? I can't project. Well, our number's 1-855-765-6681. And I don't know why I can't bring the slide down. It's a mystery to me. But my slides won't scroll. Oh, here we go. I got it. And you'll be in our room for 3 months, but I'm going to teach you how to trade. 855-765-6681. Thank you, guys. Thank you, John. And it's www.rightlinetrading.com, and you can email us at info@rightlinetrading.com. Now, I'm going to step down, and I'm going to turn this over to Lee, and watch a great system. This is for trading news, and it's a very, very accurate system. Hang on 1 second. Okay, Lee, you got it.